Welcome back to the deep dive. Look, if you've spent any time at all trying to follow the financial news lately, especially, anything about UK property, your head's probably spinning.
Oh, absolutely. It's just a constant barrage of contradictions.
Exactly. It feels like daily whiplash. One day the headlines are screaming about this mass landlord exodus, right? Warnings everywhere, private investors supposedly fleeing buy-to-let because of costs and regulations.
And then the very next day,
The very next day, you're reading about a property boom. Massive corporations, global investment funds pouring billions into UK housing assets.
it's completely dizzying.
It feels like trying to navigate a storm, but your compass is just spinning wildly.
Yeah.
How is anyone supposed to put together a clear, long-term strategy when the media narrative flips between total collapse and unprecedented growth?
Well, that's the thing. That constant noise, that short-term panic, it really obscures what's actually happening underneath, the real fundamental shifts driving the market.
And if you're serious about building wealth, you have to filter that noise out, don't you? You need to find the signal.
That difficulty, that challenge in thinking strategically, that's precisely why we're doing this deep dive today.
Yeah.
I mean, the noise often feels engineered to be deafening, doesn't it?
Yeah.
Makes clear-eyed decisions incredibly hard.
Yeah, it does.
So our mission today is simple. Cut through all that sensationalism. We need to move past the simple collapse versus boom idea and focus on what the data is actually telling us. What are the real takeaways revealing the true trend in the UK rental sector?
Okay.
And what our sources, what the data shows, is something pretty profound, actually. The UK rental market is undergoing this huge fundamental restructuring. It's shifting, I think, irreversibly from what was often, an amateur, maybe accidental or just passively managed thing
Right.
into a highly professionalized, really strategic, and frankly, hyper-competitive industry. It's all about systems and processes now.
So, for anyone involved in property or even thinking about it,
This is the moment. It's pivotal. You have to adapt. So we're going to look at 5 maybe surprising realities that are really defining the landscape for investors, looking ahead to 2025 and beyond.
okay, sounds good. So, we'll start by unpacking this myth of the great landlord exodus, why it's more evolution than abandonment. Then, we'll dig into who this formidable new global competition actually is, and maybe counterintuitively, how their rigidity might actually give private investors a strategic edge.
A key point, that one.
Yeah. We'll also try to put the housing crisis into its proper context using objective data. And finally, we'll look back at history to understand why, as Paul Samuda, who's a real veteran thought leader in this space, often advises, tenacity is key. Panic. Well, panic is for amateurs.
Fortune favors the brave, as they say. Or perhaps fortune favors the patient and well-informed.
Exactly. Let's dive in. Okay, let's tackle this first big one then. This idea that basically every private landlord in the country is, running for the hills.
The Great Escape narrative.
Right. The common story is this mass retreat, and you see it backed up with stats like almost a fifth of homes listed for sale last year were previously rented. I mean, that paints a pretty vivid picture, doesn't it? Failure, abandonment.
It certainly does. And look, those statistics, they're technically true. Some landlords are selling, particularly the less committed or maybe those caught out by rising costs. But that figure only shows one side of the story. It doesn't capture the intention, the ambition behind the numbers for those remaining.
So what's the other side?
Well, if you actually look at the data on investor sentiment, the picture is completely different. It shows resilience. It shows strategic acquisition by the players who are staying in the game. It's far from a wholesale abandonment. It's much more like a strategic repositioning.
Okay. Give me some numbers.
Okay, consider this from Landlord. They surveyed active buy-to-let owners, the ones who've weathered the recent storm of rising rates, regulatory changes, all of that. A remarkable 70%, 70 of those landlords intend to acquire more properties over the next 12 months.
70%. Wow.
70%. Now, that is not the behavior of a sector in full retreat, is it? That's consolidation, that's growth. It suggests they're absorbing the assets from those who couldn't adapt or didn't want to.
That figure really is staggering, especially when you think about the headwinds, Section 24 kicking in fully, the higher cost of finance. This isn't cheap growth they're planning.
Exactly. The commitment runs deep. And there's more. Another major survey, this one from Benham and Reeves, found that even after navigating all those challenges, 84% of landlords plan to remain in the buy-to-let sector.
84%.
Yeah.
Okay.
Now, okay, the data does show sentiment is cautious. Around 42% reported being more cautious about market prospects, which is understandable.
Sure.
But the intent to stay to refine their strategies and to actually grow strategically, it's completely undeniable among that professional group.
So if the strategic players are staying and even planning to grow, they must be adapting. It's like you said, a refinement of strategy, not just running away. What does that refinement actually look like on the ground? What are these investors doing differently?
Well, the strategies they're adopting really show this evolution perfectly.
Mm.
I mean, the old passive approach. Just buying an aging property, maybe handing the keys to a local agent,
Yeah.
and hoping for capital gains while barely breaking even month to month.
Yeah, those days seem gone.
Those days are absolutely over. The requirement now is active management. Active management for cash flow, active management for compliance. It's a business.
Right.
So the two most popular refined strategies investors are focusing on now really show this shift. First is buy and hold. Still popular, cited by about 38.7% of landlords. But the definition of buy and hold has changed fundamentally.
Yes, so.
When we talk about buy and hold in 2025, we mean holding assets that are highly optimized, assets that are cash flowing exceptionally well after all the increased costs and taxes.
Okay, what does highly optimized actually mean in practice today? What are they doing?
It means squeezing every bit of allowable efficiency out of the property and proactively dealing with regulatory risk. So optimization now really centers on energy efficiency, making sure properties hit those looming EPC standards to avoid huge refurbishment bills, or worse, being unable to rent them out at all.
The EPC cliff edge.
Exactly.
Mm.
It also means potentially maximizing allowable occupancy, maybe moving into more profitable HMOs, houses in multiple occupation where local planning allows it. That can significantly boost yield.
Right, if managed properly.
It's managed properly, absolutely. And for some, it means looking at hybrid models, maybe mixing in some short-term rentals or serviced accommodation, SA, within their portfolio, especially in commuter hubs like Reading maybe, or city centers like Birmingham to leverage those higher nightly yields. It's about finding every angle to make the asset work harder.
And the second strategy you mentioned.
The second is the BRRR method. That's buy, refurbish, refinance, and then rent. Now, this requires a much higher level of professional skill, doesn't it? You need specialized capital, deep knowledge of renovation management, finance.
It's definitely not passive.
Not at all. It's a move away from just being a landlord towards being an active property entrepreneur. It takes courage, yes, but it's how investors are adding real, measurable value today, forcing appreciation rather than just waiting for it.
So that really is the core takeaway here, isn't it? The story isn't everyone's leaving. It's that the less prepared, maybe the accidental landlord, someone who inherited a house or bought one asset years ago without much advice, they are the ones exiting.
Precisely.
And they're being replaced, or their properties are being bought up by experienced investors who are repositioning strategically. It's a serious filtering process. It demands systems, professional help, maybe from firms like Essential Management or their brands like Essential Property Options or Stay & Co. who offer that kind of support.
It's exactly right. As property veterans, like Paul Samuda, often stress you have to view your portfolio as a business, not a side hobby anymore. This whole process, this market professionalization, it's making room for those who treat property investment like a true, scalable business. The market's rewarding resilience, it rewards long-term, data-driven strategy, and that actually creates opportunity when others are panicking.
Okay, this is where, for me anyway, it gets really interesting. Because even for those professional investors, the ones who are determined to stay and grow, the whole competitive landscape has just fundamentally shifted.
Completely changed.
For decades, your competition was, local, the landlord down the street, maybe a small company owning a few properties nearby. But who is this new, truly formidable competitor that's changing the entire game today?
Well, the new players are massive. We're talking large-scale corporate institutions. And they're leveraging the build-to-rent model, or BTR. This isn't just a small adjustment in the market. This signals a huge shift, like tectonic plates moving, in how global capital sees UK residential property. You really need to follow the money here.
And the money's flowing into standardized blocks of flats.
Essentially, yes. Standardized, professionally managed residential assets. The driving force behind it is this massive reallocation of capital away from commercial property.
Right.
Think about it. Large property companies, pension funds, they're looking at the volatility in commercial real estate.
Empty offices, struggling high streets.
Exactly. Post-pandemic blues, online shopping impact. They're selling off those assets and pouring billions, literally billions, into what they see as the stability and guaranteed demand of residential property. Residential, unlike commercial, has proven incredibly resilient, especially in high-demand areas, where there's this structural undersupply we keep talking about.
And we're not just talking small funds nibbling at the edges here, are we? These are financial heavyweights.
Oh, absolutely. We're talking major players. You've got Lloyd's Bank, for instance. They've announced really aggressive plans to own 50,000 rental properties by 2030 through their new division, Citral Living.
50,000 properties, just one bank?
50,000. It's a staggering volume of housing coming under single institutional ownership.
Wow.
Then you've got the global investment giants like Blackstone, huge in private equity, and massive pension funds, Aviva, Legal and General, LNG. They are all piling into this sector. Why? Because they need reliable, long-term, inflation-linked income streams for their pensioners or investors. Yeah. Residential property, especially BPR, offers that.
The sheer scale of it is hard to comprehend.
It really is. And that scale is what should grab your attention. Just look at the numbers for 2024 alone. 282,500 build-to-rent homes were either completed or actively under construction across the UK. And these aren't just basic conversions. These are purpose-built blocks. They often offer everything from gyms, communal workspaces, concierge services, the lot. This is a serious market takeover by institutional capital, consolidating huge chunks of the rental sector, particularly in major regional cities. Think Birmingham, Manchester. They're seeing massive BTR development.
Is this institutional rush into residential unique to the UK, or is it happening elsewhere too? Knowing if it's global helps understand if it's, structural and likely to continue.
That's a great question. It's definitely a global trend. You see similar moves in the US, Germany, other places. But the UK offers a particularly attractive environment. Why? Because of that chronic structural housing deficit we'll talk more about, plus a very robust, liquid legal system that big capital likes.
Right. Predictability.
Yes, exactly. Institutional capital sees the guaranteed long-term scarcity here, the built-in demand, and views UK residential as a secure, almost inflation-proof investment. We saw a similar thing accelerate in the US single-family rental market after the 2008 crisis.
Yeah.
The playbook is pretty established. Find a fragmented, maybe undercapitalized market and institutionalize it.
What's fascinating and maybe a bit scary for the individual landlord is the professionalizing effect this BTR wave has. It seems like it's raising the quality bar for absolutely everyone.
It is, absolutely. And there's a really good analogy for this. Think back to the student rental sector maybe 15, 20 years ago.
Okay.
Before the big players like Unite Students arrived, that market was dominated by smaller, often pretty low-quality individual HMOs, right? Shared houses, sometimes a bit rundown.
Yeah, I remember those days.
Then, these large-scale providers came in and built purpose-built student accommodation. High-quality blocks, highly managed, gyms, security, all-inclusive bills, professional service.
Changed everything.
Changed everything. And the consequence for the smaller, traditional landlords was immediate and pretty harsh. They faced a stark choice. Update your student houses significantly, meet these higher expectations, or you'll struggle to find good tenants who now have a much better alternative.
And you're saying BTR is doing that to the entire private rental sector now?
Exactly the same dynamic. If you're a private investor today, you must run a professional, systems-driven operation. Because your competition now literally has call centers, 247 maintenance systems, apps for reporting issues, and brand new, high-spec, standardized assets. It's why services like those offered by Essential Management are becoming, well, essential for private landlords who want to compete. They provide the systems and professional edge.
So the implication is crystal clear then. This BTR wave is lifting tenant expectations across the board. Doesn't matter if you own one house in, say, Crewe or a portfolio in Burton. You're now competing, indirectly at least, against a corporate service level.
Precisely. This isn't market collapse. This is market consolidation and professionalization. It's demanding that every single player raises their game.
Okay, but hearing all that, this corporate intrusion, it sounds incredibly daunting. I mean, how can a private investor, even a professional one, possibly compete with the sheer resources of a Lloyd's Bank or a Blackstone? They can offer gyms, concierges, brand new buildings. It feels like a totally uneven fight based just on capital and scale.
It does seem that way on the surface, doesn't it?
Yeah. But you mentioned earlier, and our sources suggest, that the very nature of these big corporate landlords, their rigidity, their scale, might actually hand private investors a strategic weapon.
That's the absolute critical pivot point for private investors in this new market era. You have to understand this. The BTR model's greatest strength, its massive scale, its standardization, its reliance on automated systems, that is also its Achilles heel. Well, they offer fantastic amenities, sure. Brand new kitchens, maybe an on-site gym.
Yeah.
But they often come with premium rents, sometimes hefty service charges on top, and crucially, rigid, impersonal corporate policies. There's often zero room for human nuance or flexibility. So, the private landlord, you probably can't offer an on-site cinema room, but you can offer something that's potentially far more valuable to a really significant chunk of the tenant population. Flexibility, a human relationship, a personal touch.
Things a corporation just can't replicate at scale.
Exactly. They are structurally incapable of replicating it efficiently, which means that personal service, that flexibility, it's no longer just a nice-to-have soft benefit. It is now a quantifiable, key competitive advantage. It needs to be consciously baked into the private investor's business strategy.
Right. Okay, let's get into the weeds then. How exactly can a private investor use these human factors strategically? How do you differentiate yourself to win tenants away from these shiny new BTR blocks? What are the specific opportunities?
Yeah, we can break it down into maybe 3 key areas of differentiation. First, and perhaps most obviously, is flexibility versus rigidity.
Okay.
BTR policies have to be standardized for efficiency. It's non-negotiable for them. If a tenant asks for something slightly outside the standard lease terms or payment schedule, the centralized management software, the call center script, it just says no, because exceptions mess up their scalable model.
Right. Computer says no.
Pretty much. Whereas a private landlord, especially one working through a responsive, perhaps more boutique management firm like, say, Comfort & Co., they can adapt almost immediately.
Give me some examples. What kind of flexibility makes a real difference?
Think about huge ones.
Mm-hmm.
Being open to tenants with pets, that's still a massive hurdle in much of the corporate rental market, very restrictive policies usually.
Mm-hmm.
Or maybe accommodating slightly shorter lease terms if a tenant is, say, relocating for a project and doesn't need a full 12 months.
Okay.
Yeah. Or even something as simple but hugely appreciated as allowing variable rent due dates. Maybe aligning the rent payment day perfectly with when the tenant actually gets paid each month.
Right.
A BTR block probably can't manage that complexity across hundreds of units. You can.
Little things that make a big difference to the tenant's life.
Exactly. These small acts of flexibility, they build immense loyalty. They attract high-quality, long-term tenants who are actively looking for a more customizable human experience. You're essentially trading a tiny bit of administrative simplicity for potentially massive gains in tenant retention and satisfaction.
That makes total sense. Flexibility is often worth paying a bit for, or choosing over a gym you might not use. What's the second area?
Second is the difference between a personal relationship versus a corporate portal. This becomes massive when, inevitably, issues arise.
The dreaded call center experience.
Precisely. Corporate landlords, they funnel tenants through online portals, maybe offshore call centers, outsourced maintenance teams who are just working off strict protocols and service-level agreements. If your boiler breaks in a BTR flat, the process might involve submitting an online ticket, waiting maybe 48 hours for someone to even diagnose it, then maybe another week while they get parts approval from head office.
It can be incredibly sterile, slow, and just intensely frustrating for the tenant.
Totally. Whereas you, as a private landlord or working through an agile dedicated management service, you offer or can offer a direct line of communication, maybe even your mobile number, or a dedicated manager who knows the property and knows you.
Right, someone with a vested interest.
Exactly. Many tenants, maybe most tenants, will always prefer dealing directly with an owner or a manager who actually cares about their satisfaction and the property's upkeep, rather than battling a faceless corporate machine that's just ticking boxes and managing KPIs. That responsiveness is a massive strategic asset, especially in competitive markets like, say, Birmingham or Reading.
Okay, and the third point of differentiation you mentioned was tenant independence versus a managed lifestyle. That's interesting. I hadn't really considered that some tenants might actively reject the BTR approach.
Oh, they absolutely do. Particularly more established professionals, maybe families. BTR developments often heavily market this highly managed lifestyle. Think organized community events, shared workspaces, maybe strict rules about using common areas or having guests.
Right, trying to build a community.
Which works brilliantly for some demographics, maybe younger tenants fresh out of university seeking that social element.
Yeah.
But many others, perhaps older professionals, couples, families, they actively want to avoid that managed, almost campus-like environment.
They just want a home, not a lifestyle package.
Precisely. The private rental, in contrast, typically offers a much greater degree of independence and minimal interference. It appeals strongly to tenants who really value their autonomy and privacy. They don't want to pay extra through rent or service charges for shared facilities they'll never use, nor do they necessarily want a corporate management team organizing their social life or policing their communal spaces.
So the private landlord offers a pure housing solution, maybe free from those mandatory lifestyle add-ons.
Exactly. It's a different proposition.
This is such a vital lesson, I think, for any private investor navigating this new era. Your business model has to shift. It's not just about collecting rent anymore. It's about providing superior, personalized service. It's about understanding and actively exploiting the competitive edge that these corporate giants, simply because of their scale and standardization, cannot touch.
You said it. You absolutely have to run your operation like a truly responsive service provider now. Otherwise, you risk losing your best tenants to the BTR giants who, despite their impersonal nature, do offer a certain standard of newness and amenity. You compete on service and flexibility.
Okay, so this whole process we're describing, this market evolution, this professionalization, it's all happening against a backdrop of, let's be honest, pretty negative public sentiment towards landlords.
Understatement of the year, perhaps.
Yeah. Landlords are consistently scapegoated in the media, often painted as the primary cause of the UK's housing affordability crisis, responsible for high prices, high rents, the lot.
The pantomime villains.
Exactly. But if we're going to operate as strategic, professional investors, we have to look past that noise, past the headlines, and use objective data. We need to set the record straight, at least in our own minds, on what's really driving housing inflation.
Absolutely critical. And what's fascinating when you actually dig into the objective data is that it completely debunks this popular narrative that buy-to-let landlords are the main drivers of unaffordability.
Really? What does the data show?
Well, there was a detailed study by the Bank of England, no less. They looked at house price growth all the way back to the year 2000. And their conclusion was that buy-to-let demand likely explains only about 10%, 10% of the house price growth we've seen since then.
Wait, hang on. Only 10%.
10%.
That implies that a massive 90% of the reason UK housing costs have surged over the last, quarter century is down to other factors entirely.
Correct, 90%. And that huge chunk is attributable mainly to two massive engines working together over decades. Firstly, overly accommodating lending policies for a very long time. And secondly, and most critically, a deep, persistent, structural undersupply of homes.
Okay, let's unpack those. First, the lending policies. Why accommodating, and how did that fuel 90% of the price growth?
Well, think about the period after the 2008 crisis. Interest rates were held at rock bottom, near zero, for over a decade, right?
Right. Emergency levels became the norm.
Exactly. This made mortgage borrowing incredibly cheap. It allowed buyers, both owner-occupiers and investors, to borrow significantly more money than they could have afforded historically, relative to their incomes. This massive wave of cheap credit poured into the market, boosting everyone's purchasing power.
Which just pushes prices up.
Directly. It fueled demand across the board and drove prices up much, much faster than wages or general inflation. So it was the ease of access to large amounts of capital, not purely the existence of the buy-to-let sector itself, that massively inflated the market.
Okay, that makes sense. But you said the more critical factor was structural undersupply.
Yes, because even with cheap money, if you had enough houses being built, the price rises would be moderated. But we don't. The numbers here are just stark. They're unforgiving. England needs around 250,000 new homes built every single year. That's just to meet new demand from population growth, smaller households forming, replacing old stock, etc.
Okay, 250,000 needed. How many are we actually building?
Currently, England builds approximately 170,000 new homes per year, give or take a bit depending on the year, but consistently way below what's needed.
So, quick maths. That's a fundamental yearly deficit of 80,000 homes.
80,000 homes. Every single year. That deficit accumulates. Year after year after year, it guarantees that supply consistently fails to keep pace with demand, pretty much regardless of what private landlords or interest rates do in the short term. That gap is the fundamental, inescapable truth driving long-term price and rental inflation.
And that national deficit of 80,000 homes must manifest really starkly at the local level, too.
Oh, absolutely. You look at areas experiencing regional growth, maybe places like Stoke-on-Trent or Crewe, benefiting from infrastructure projects or regeneration, demand increases locally. But if the local planning system struggles to approve and deliver the required density of new construction quickly enough,
Which it often does.
then that national 80,000 shortfall becomes incredibly tangible right there. You see it in rising rents, increased competition for every available property, whether it's for sale or rent. That national deficit is the root cause, the pressure cooker.
If that 80,000 annual deficit is the real structural engine of the crisis, shouldn't policy be laser focused on that? On planning reform, on funding infrastructure for new homes, rather than, say, tinkering with landlord taxes, which arguably just suppresses the supply of rental stock further?
Logically, yes, absolutely. If the goal is truly affordability through supply, that's where the focus should be. But policy, as we know, is often driven more by politics and headlines than by pure economics.
Right. Blaming landlords is perhaps easier than fixing planning.
It can seem that way, and the irony is the system isn't rigged in favor of property investors at all. In fact, if you look objectively, it's actively stacked against them compared to, say, first-time buyers, which just proves how resilient and professional investors have to be now just to operate viably.
How is it stacked against them?
Well, look at the regulatory hurdles a professional landlord faces today that an owner-occupier doesn't. First, investors face higher stamp duty land tax surcharges, that extra 3% slapped on top of the standard rate. That immediately adds tens of thousands to the cost of buying a property compared to a first-time buyer.
Okay. Significant barrier.
Huge. Then they've had the complete loss of mortgage interest relief, Section 24. This was a massive blow. It fundamentally changed the tax calculation, forcing many profitable landlords on paper into making actual cash losses just to remain compliant, especially higher-rate taxpayers.
Right. Taxing revenue instead of profit for financing costs.
Exactly. And on top of all that, they typically require much larger deposits just to get financing in the first place. Lenders usually demand at least 25% deposit for a buy-to-let mortgage, whereas first-time buyers, often supported by government schemes like Help to Buy or 95% mortgages, can sometimes get onto the ladder with as little as 5% down.
So the objective reality seems pretty clear. The structural housing deficit is the real 90% problem. And landlords, far from being the villains getting an easy ride, are actually navigating a system that makes it progressively harder and more expensive, not easier, to provide the rental housing that the country desperately needs because it's failing to build enough homes overall.
That's what the data strongly suggests. They're providing accommodation the system itself fails to deliver, while facing increasing financial and regulatory headwinds.
Okay, so we've established the market's professionalizing. The competition is now big institutional players. But the long-term fundamentals of demand, driven by that huge structural deficit, remain incredibly strong. So what does all this mean for actual strategy, for the professional investor listening to this?
Well, it means embracing that long-term view, a data-driven perspective, and crucially, learning to block out the short-term noise, the panic, the daily headlines. This is where that idea of tenacity, resilience, patience, where they become the absolute key metrics for creating wealth and property.
Not just metrics, but almost required characteristics now.
Almost prerequisites, I'd say,
Mm-hmm.
because history, the historical data, is just absolutely unforgiving on this point. Panic selling, reacting emotionally to negative headlines or short-term economic wobbles, is the single most reliable way to destroy property wealth. It just is.
And conversely.
Conversely, patience, combined with holding good quality, well-managed assets and having a long-term perspective, that is consistently rewarded in UK property. Every single major property crisis in modern English history, every single one, has eventually been followed by a period of unprecedented growth for those who held on.
Okay, let's look at the evidence. The big one everyone remembers is 2008.
The ultimate case study, yes. The global financial crisis. The panic then was palpable, wasn't it? News broadcasts were talking about total financial system collapse. London property prices fell sharply, over 15% in quite a short period.
Yeah, I remember the fear.
And thousands of landlords and homeowners, too, they panicked. They sold their assets, often at substantial losses, completely convinced the market would never recover its previous highs.
But the data for those who didn't panic, who held their nerve, it tells a pretty incredible story, doesn't it? It really demonstrates that power of time in the market rather than trying to time the market.
It really, really does. Those strategic investors, the ones who ignored the screaming headlines, focused on managing their cash flow, maybe refinanced carefully, kept their high-quality portfolios.
Yeah.
They were rewarded spectacularly. By 2014, which is only 6 years later, not a lifetime average, London prices had surged. They weren't just back to pre-crisis levels, they were 40% higher than their pre-crisis peak.
40% higher in just 6 years after that kind of crash.
Exactly. They didn't just recover their paper losses, they achieved massive capital gains simply by being patient and holding fundamentally sound assets in a supply-constrained city.
Was that just a London phenomenon, though? London often behaves differently.
That's a fair question, but no. It wasn't just a quirk of the London market, although London often recovers fastest. We saw very similar patterns, maybe slightly lagged, but similar sharp recoveries and then sustained growth trajectories for investors in major regional hubs too.
Such as?
Cities like Manchester, Birmingham,
Yeah.
they saw similar dynamics. Even fast-growing commuter belt towns, places like Reading again, they followed similar patterns. If you held decent assets through the downturn, you saw significant sustained growth in the years immediately following that crisis. The lesson really seems universal in UK property investment. The market rewards resilience and patience.
That historical recovery is compelling, but let me push back slightly here. Could we argue that the 2008 crisis and maybe even the COVID-19 shock more recently were both fundamentally financial crises, and they were ultimately solved, or at least papered over, by massive, unprecedented government intervention, quantitative easing, near-zero interest rates, furlough schemes, stamp duty
It's
holidays?
true, the interventions were huge.
So, if the next downturn isn't a short, sharp financial shock, but maybe a longer, more structural grind driven by persistently high borrowing costs and maybe ongoing regulatory pressure, without that safety net of massive government stimulus,
Yeah.
can we still confidently rely on those historical recovery rates? Is the underlying engine the same?
That's a really crucial distinction to make and a very fair challenge. It goes back to the difference between those short-term cyclical shocks and the long-term structural fundamentals. Now, while government stimulus undoubtedly accelerated the recovery speed after 2008 and COVID,
Yes.
the underlying driver of that eventual growth was still rooted in those structural realities that haven't gone away. If anything, they've got worse. Namely, the severely limited housing supply and the continuous underlying demand from population growth and household formation.
So even without massive QE next time,
Even without massive QE, the fundamental imbalance, that fact that we are building 80,000 fewer homes every year than needed, acts as a powerful inflationary floor under the market long term. People still need somewhere to live. When housing supply is structurally constrained like this and demand is constantly demographically rising, any downward pressure on prices caused by, say, higher interest rates is inherently fighting against a much stronger tide. The private market eventually has to correct upwards, because that structural deficit guarantees demand will ultimately outstrip any temporary economic shock or policy intervention.
we saw that dynamic play out very recently, didn't we? During the COVID-19 pandemic itself, the forecasts then were absolutely dire too.
They were. Remember, market forecasts were predicting doom. Some highly respected analysts and models projected a 30% crash in property values as the economy basically seized up and nobody could even view houses.
Yeah, seemed plausible at the time.
It did. Yet what actually happened? The reality was precisely the opposite. Property prices across England didn't crash. They soared to record highs by the end of 2021. It proved, yet again, that the underlying structural demand and the chronic low supply ultimately trump even massive, unprecedented short-term economic shocks.
So the lesson from history holds, even through different types of crises.
The core lesson seems crystal clear, yes. Reacting to fear, reacting to short-term volatility, making decisions based on scary headlines. It's an amateur's game. The professional investor, perhaps advised by experienced heads like Paul Samuda and supported by professional teams like Essential Management, understands that property is a long-cycle asset. True wealth isn't made in months. It's created over decades.
So the most profitable strategy is?
Often the simplest, though not always the easiest, emotionally. Patience. Operational tenacity, managing your assets well day to day. And fundamentally, trusting the long-term data over the short-term noise. #tag outro.
Okay, so let's try and synthesize the key takeaways from this deep dive then. It feels like the main message is the UK rental market isn't some kind of disaster zone investors should flee from. Instead, it's undergoing this really profound and probably necessary professionalization.
That's it in a nutshell.
The era of the, accidental landlord just stumbling into it, that's decisively over. It's being replaced by a landscape that demands a strategic approach, a systems-driven operation. Success really seems to hinge on understanding that new competitive landscape, especially those big institutional BTR funds, and then consciously leveraging your own strategic advantage as a private investor, which seems to be at that superior personalized service and the irreplaceable human touch.
Perfectly put.
Yeah.
And underpinning all of this, when you look forward through a clear, data-focused lens, the future is anchored by these immutable long-term fundamentals. These aren't just cyclical trends that might blow away next quarter. These feel like structural certainties that provide real ballast. Namely, that massive annual structural housing deficit, 80,000 homes short every single year. That means demand is constantly building, constantly intensifying pressure on the existing stock. Couple that with a UK population that's still projected to grow by millions over the coming decades.
Right, more people needing homes.
Exactly. Those two factors combine chronic undersupply and rising demand. They virtually guarantee continued intense need for rental properties for the foreseeable future, almost regardless of short-term economic cycles.
Those fundamentals should be the guideposts then, the things to hold on to when the inevitable market storms hit.
They absolutely should be. They should steady the strategic investor through any short-term turbulence, the market volatility we see, the noise, the landlord exodus headlines. In many ways, it's simply the market filtering out the uncommitted or the unprepared. It's actually creating opportunities for those who are ready to treat property investment as the serious, long-term professional business that it absolutely has become.
So the message is clear. The market is evolving, definitely not collapsing, and your success depends entirely on your ability and willingness to evolve right alongside it.
Exactly. And perhaps that leads us to the final thought for listeners to mull over. As this market continues its profound evolution, the critical question you need to ask yourself is no longer simply if you should be a landlord, because the fundamentals strongly suggest, yes, the demand is undeniably there.
Right.
The real strategic question now is what kind? What kind of professional, systems-driven, service-focused strategic landlords must you become to not just survive, but to truly thrive in this demanding but potentially very rewarding new era of UK property investment?